You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest, Senior Options Analyst and author of The Options Playbook. Well, we have had a couple of strategies that we've done that weren't quite as advanced as we always talk about on Options Playbook Radio. And I always like to try to look for scenarios where I can talk about a few more basic strategies. And today we're going to look at the fig leaf one more time. A few weeks ago, we looked at a fig leaf. And a fig leaf, another name for it, is a leveraged covered call. And we looked at a fig leaf about 3 weeks back. And my biggest thing on Options Playbook Radio is we're just going to talk about times where strategies apply. We're going with the mindset that there's over 40 different strategies inside the Options Playbook, and we're not necessarily picking the underlyings. We're just saying, when might I do this strategy? And today I'm going to kind of piggyback off of our midday market call, which myself and Michael Kahn, who is a chart technician, did this Tuesday. And the stock that he picked was CSX Corp, the railroad. And he was looking more so for a bearish move after earnings, but the biggest thing about his forecast was a breakout. If you could get the expected move, which was about $3, either to the upside or to the downside, it was right on a support line or a resistance line. I don't know which way you want to look at it. And just a very either it was going to be a very positive move to the upside or a very negative move to the downside. Just a very volatile outlook overall. So this is a great time in my mind to look at a strategy like a fig leaf or a longer term, more conservative type option strategy. Now, obviously, you could just go out and do a covered call, and this would be the alternative to that covered call. But once again, CSX Corp is a good underlying, the railroad company. Just I'll keep saying that. C as in Charlie, S as in Sam, X as in X-ray. That's the symbol and also the name of the company. And it's an $80 stock. Well, right now we're taping Options Playbook Radio. It's about 3:30 on Wednesday, April 17th. The markets are still open. CSX Corp announced earnings last night. It's up $3. Right now it's showing me if I unplug my real-time quotes, it's at 78.93 exactly right now. So almost $80 after a 3-point run up today. And we're going to go out further in time. If you look inside the Options Playbook, you'll see on a fig leaf, we always talk about longer dated options, even looking at LEAP options. So LEAPS is just an acronym. It stands for Long-Term Equity Anticipation Securities. All it is longer dated options. And the Chicago Board Option Exchange came up with a fancy term so that they could market it a little better. But that's all it is longer dated options. Today, we're not going to go all the way out to a LEAP option. That would be going all the way out into 2020. We're going to look at a September option contract. But the biggest thing to make it a true fig leaf is that we're going to look at a high delta option contract. The whole goal of a fig leaf is to have an option contract be a surrogate for the stock. And the only way that it can be a true surrogate for the stock is if the stock's got a delta of 1, obviously, and the option contract would have a delta of 1. Then you basically get the same type of movement from the option as you do from the stock. But if we go that deep into money, then there's no real benefit to trading the option overall. So we like to look for something right around 80 delta. And the option that I picked today is it's in the money, about $9. We're looking at the 70 strike call option. We're going to go until September 20th. So it's the normal expiration date going all the way out till September 20th, which is 156 days away. So we're obviously bullish. We're buying a deep in the money call option. And we're going to say, well, we broke out to the upside, so we're going to take advantage of that. And we're also going to take advantage, when we're looking at this type of strategy, of the fact that earnings were just announced. And we've had a large volatility crunch because of that known event. Volatilities have came down. And ideally, the longer you go out in time, the actual movement on a percentage basis because of a volatility crunch a lot of times is lower on longer term options than shorter term options, but it's sometimes a bigger number just because overall time premium is larger on longer dated options. So that means volatility can mess with that time premium a little bit more. So with that said, once again, Options Playbook Radio isn't about giving you strategies and saying this fits into your portfolio. Nothing's meant to be a recommendation. All we're looking at doing is saying, here's a scenario, and maybe you can find a stock that applies that fits in your portfolio. So we have an $80 stock. It's not a real expensive stock, but it's going to cost you, $8,000 basically to buy, or not basically, it's going to cost you $8,000 to buy 100 shares of stock. And we're going to lower that cost. We're going to buy something that's a surrogate to that stock, and then we're going to sell some premium to help pay for it. So let me set up the call, and then I'll talk a little bit about the premium and how we need to manage this trade. So in this instance, once again, SCX Corp, it's around 3:30 on April 17th. The stock announced earnings last night. It's up $3. The stock is at $78.93. We're going to go about 9 points in the money, and we're going to buy the 70 strike call option. That has a delta of 84 cents on it. And then at the same time, we are going to sell a short-term option against it, and we're going to sell the May 17th expiration, 30 days away, 82.50 call. And we're going to do this entire trade for a net debit of $10.41 to the account. So we've got something that acts a lot like just a normal covered call option, but we're doing it at a lot less money, but we're going to do it in the same amount. So the concept of a fig leaf is if you were going to buy 100 shares, you still go on out and buy one fig leaf, one by one spread, right? So we're not trying to add risk to the trade. We're actually using options as they were first intended. We're going to limit that risk to the dollar amount that we paid for it. So in this instance, 1041 times 100, which is what the option contracts represent, 100 shares, is $1,041. Now that's quite a bit different than paying $8,000 for 100 shares. Now, granted, you could sell the May 17th call against that 100 shares, and what that's bringing in right now is about 40 cents on that option contract. So you're bringing in about 40 cents on that trade. But that's a lot less of a percentage of an $8,000 purchase as opposed to a $1,041 purchase, if you get what my meaning here. So I think this is a scenario where if you were bullish on CSX, it's a little bit of an expensive stock, and you want to get a little bit long-term bullish on it, where a fig leaf would apply. That's why I decided to bring this up, considering that the underlying basically did what we talked about on the midday market call. We'll see if it continues to move to the upside. That was Michael Kahn's call on that instance, and we're going to end up doing the fig leaf on the trade. Now, this is still an option contract. It's got a high delta. The delta is 84, which here's a little quick and dirty thing about options is that if the delta is not 1, means the option contract has time premium in it. The only time that an option contract, in theory, now delta is a total theoretical number, but the only time the time period should be 0 on an in-the-money option contract is when your delta is reading 1. That means that it's basically acting like the stock. It's moving 1-to-1 with the underlying stock. So we do have some time premium. So this is where the fig leaf comes in. Time premium still can decay. If I look at the 70 strike call and I look over at the put, a quick way to see the approximate time premium of that option contract is just look at the value of the put. So in this instance, the time premium is $1.45 at the midpoint. That's what the time premium is of that put. So we don't need it to be exact, but what we're going to try to do is sell calls against this to whittle away at that time premium, just in case we're incorrect on our forecast and maybe it goes down before it goes up, that type of thing, or it continues on down. Now, in this instance, if we do that, $1.45, we're bringing in 40 cents. We're bringing in a third of that time premium, and we're only going out 30 days in time. So it's just a nice way to look at your fig leaves when you're setting up. Ideally, I probably want to sell calls against it up until the point that I actually cover the time premium that I paid for in the option contract. Then I probably have something that looks a lot like the stock, just flat out. I didn't pay any time premium for the option. The delta might be a little bit different based on if the stock went up or went down. But my whole goal is to try to get the time premium paid for by selling near-term covered calls against it. Okay, so that's one little way to look at a fig leaf or a leveraged covered call, which is an AKA name inside the options playbook. Now, the other thing that is worth mentioning is we don't own a stock, right? We own something that looks like the stock. And this is where the term fig leaf comes from. And we actually reached out to our trader network back in the day when we were Trade King before Ally Invest bought us out. And we had somebody suggest that, well, why don't you call it a fig leaf? Because you're not fully covered, you're kind of covered. Well, in the options trading world, you are covered because you have the right to buy the stock at a lower price than you have an obligation to sell it at. But you're right in that option is still an option. It's not a delta of 1. It still has time premium in it. And if you are assigned, you're going to want to do something. You're not going to just give up your stock because you don't have the stock. You still have the option. So the question becomes, what if the stock does go to 85? Right now, our short strike is 82.50, and I have to make a decision at that point in time. What could I do? Well, my options are, and most of the time you're going to do this on a fig leaf scenario, is you're just going to sell and close the position. You sell everything out. You just get out of it. You can still do that. You can do it even in pieces. You can leg out of it, but you just got to close the short leg first before you sell the long leg, or you would be considered naked in that position. The other thing that you can do is if that is the case, what I really want to do in the fig leaf is make sure I know when that stock gets to 82.50. If the stock gets to 82.50, I am then going to go and roll that option contract. And there is a section inside the options playbook called How We Roll, and it specifically talks about rolling covered calls. But the biggest thing about rolling is not letting that short option get too far in the money. So if I'm doing a fig leaf, I'm just not going to let the short option get in the money. The only way, obviously you can't prevent it gapping in the money on the open or something, but if it's anywhere around 82.50, I'm going to look to probably roll that call option up and out. Right? So I go out further in time and you go up in strike. As long as you act fast, you should still be able to do that for a net credit to your account. So I'm going to pay much closer attention on a fig leaf than on a covered call because flat out, I don't own the stock. Now, another thing that's said, and I just think about all the Apple traders out there that Apple had kind of a fun ride recently. went down, about 15% and then came roaring back about 30%, that scenario. Well, if you have a fig leaf on an expensive stock like that, your risk to the downside is limited. You still have, even though it's $10, which is a fairly decent price, it's still $10. You can't lose anymore. And in Apple, that loss happened quickly, but then it also came back quickly. So there's a scenario in a high-priced stock where it went down, and it would have been nice to be in a fig leaf as opposed to being in a covered call in Apple. It's an interesting alternative. So the one thing that's really nice about this is we have an $80 stock. We're putting up $10 on an $80 stock. So in that instance, we're putting up 12% of the actual stock price. And we can get out earlier. We can close out this position. We don't have to ride it all the way to expiration. But we know that there's no way we can lose more than 10% on this trade if we do this trade. It's that simple. It's that straightforward. So interesting alternative, a little bit higher price stock. Good to do them right after they announced earnings, just because vols come in, makes it cheaper to buy that longer-term option, easier to find the delta that you want on that option contract. That's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com, theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.